We came into the week with stocks running up and the US dollar in decline, and that's where we're at as the week gets set to close out. The bottom line right now is this. Tail risk associated with pandemic fallout has become a lot less worrisome to investors, with things calming down and economic data rebounding as a consequence. This leaves investors feeling spectacular with a fresh barrage of stimulus and reinforced assurances from central banks and governments that any signs of renewed stress will just be met with more stimulus. And so not much of a surprise to see U.S. equities recovering all the way back into and towards record highs. Believe it or not, the NASDAQ has actually printed a fresh record high this week, while the S&P 500 has recovered about 80% of the setbacks from its record high to the March low move. On Thursday, the ECB followed through with its own reassurances after upping its pandemic emergency purchase program by €600 billion, and all of this has been sent a wonderful message to the currency market that it needn't be scared into holding on to US dollars for fear of the apocalypse. Currencies have impressively extended their recoveries, and this is pretty much across the board against the buck, with only the yen standing out as an understandable exception. And so long as the market continues to buy into the strategy that supports this unprecedented money printing exercise, it seems like there just isn't any downside risk that will be able to shake things up for more than a moment. After all, 2020 has been a year fraught with turmoil, and here we are with financial markets in a state of euphoria. Obviously a disconnect, but again, a disconnect easily reconciled by a central bank and government incentives to disregard the downside and invest recklessly in risk assets. At this stage, if we're to consider any potential catalyst that could rock the boat, we would suggest the possibility that global economic data starts to level out after showing recovery from the worst case forecasts, and all of a sudden begins to normalize at levels far from the normal we had seen pre-pandemic. This could be something to watch out for. Of course, there are other risks, including those around escalating global trade tension, a possible second wave of coronavirus, or that next future negative shock to the global economy that tests the resolve of central banks and governments forced to back up those reassurances with even more money printing. We think all of this continues to point to a compelling case for gold, with any setbacks in the yellow metal looking like attractive opportunities to diversify into the limited supply store of value hard asset. The case for Bitcoin is there on these merits as well, though with Bitcoin we concede that it isn't there just yet and still could be exposed to periods of risk off in the shorter term. With all of the focus on shorter-term employment metrics, today's U.S. jobs report won't be as interesting, though we suspect the event will succeed in inspiring some volatility. Other standouts on the day include the Canada Employment Report and Canada IVPMIs. That's all for now.